Thanks everybody for coming. This is the section on the buyer panel. We're going to talk about buyers, what they're looking for in terms of buying companies or investing in companies, what sort of attributes they really like, what sort of warning signs will send up the red flag and push them away from a deal, so on and so forth. So what I'm going to do is I'll introduce myself. I recognize a lot of the people in the room, but my name is Jim Perkins from the Quorum Group, Regional Director. I'm a digital media specialist. I've been in the video game industry for 22 years. I've sold to software video game companies. I've bought companies. I've invested in video game companies. Have a lot of experience. What I've asked these three gentlemen here to do is be on the buyers panel. They have experience, extensive experience in acquisitions. One has a lot of experience also in selling companies, and he'll be on the next panel as well. But I'm going to let them introduce themselves, and then we're going to get into some questions and answers and hypothetical situations, war stories, which I love, war stories, things that went wrong, things that went right, hopefully. And also turn it over to you to ask any questions you have of the panel or myself through this process. All right, Jasper, why don't you kick it off?
Hi guys, nice to meet you. My name is Jasper Smith. I'm an investor, both a private investor and invest with a consortium of other angel investors through an organization called Endeavor. We've probably made about 30 to 40 investments over the last 5 years, generally in the region of 100,000 to 500,000. Quite a lot of game development companies, a lot of digital media. We've lost our shirt on many deals. We've had a few very successful deals, and we're very committed to that type of investing. The company that we bought a couple of years ago was actually PlayJam. There was a company that I founded many years ago, so it's a company I sold and then bought back again. And we'll talk a bit more about how we sold it fairly successfully a little bit later on. But from a PlayJam perspective, or with the PlayJam hat on, we're also interested in acquiring companies. So we're generally looking at game developers, people with technologies, IP, things like that. Thanks very much.
Thanks, Jasper. Let's turn over to Matt from Silk Road.
Hi, Matt ROSZAK, Silk Road Equity. Silk Road is a private investment firm. It's myself and my partner. We manage our own fund, and we've been at this for about 9 years. And I'd love to say, looking back over the shoulder, that we had some discrete strategy when we started the business. And looking at the deals that we've done, primarily technology deals, mostly in the cloud, SaaS space, gaming space. They were all relationship driven. People that we knew, people that we liked, people that we trusted, people that needed money, ran out of money, has kind of coalesced the portfolio of about 20 plus companies that we've invested in thus far, and have also made about another 10 add-on acquisitions along the way. So been very active in buying, selling, raising money, and what you'll learn is it's never a straight line, and hopefully you'll glean a little bit of how to stay on a certain line on the graph here as you move forward. But that's a little bit about Silk Road.
Thanks, Matt. And Deepak from Intel.
Yeah, my name is Deepak Natarajan. I cover Southeast Asia, Australia, New Zealand for Intel Capital. And for those of you who are wondering why does Intel Capital care about gaming, it's because we see gaming as a very viable destination for broadband users. And we've seen consistently that encouraging broadband use in emerging economies especially has a very direct correlation to consumers' need and their desire to buy devices, which is where Intel comes in, because we either sell chips and software that go into devices, or we sell devices themselves. So it's an indirect way in which we can create demand for devices that have rich media capability, that need powerful chips, all of which that Intel wants to deliver to the market. Now, we also invest in other areas which somehow influence all this. For example, I think we've heard a lot about mobile gaming and social gaming and gaming through browsers and so on. And every one of those, for every 5,000 devices that do those things, there is a big honking server sitting somewhere that has to deliver this content and hold the content and have this and do all that. And there again, Intel has a significant interest, and at this point, a significant market share. I think 90 to 95% of the servers that run all these applications and games and so on run on Intel architectures. So we have a significant interest in the segment. We've made, as of this point, actually, there are 5 current investments that we've made around the world, and there are probably 2 or 3 others that we've exited in the past. I myself, unlike this gentleman here and Jim, I'm not an expert in the gaming space because I cover the region and not the sector. But we have 2 guys in Santa Clara who cover the sector vertically, and so I think those of you who've been in this industry long enough know Alex Marquez and his colleagues who do that. So.
Great. Thanks, Deepak. All right. I'm going to start with a question that for a couple of the panelists. Do you originate the deals? And this is more for Jasper and Matt, or do you do most of the deals come to you, or do you go and pursue those deals?
Yeah, I'd love to say that there's some institutional process on deal flow, and it's sometimes pretty random. It's either like a cocktail party tonight or a quorum information memorandum that we get, and it's I'd love to say that there's one or the other, but it keeps you active, it keeps your eyes wide open to make sure that that relationship continues, because whether you meet that entrepreneur or that VC, it might be that direct deal, or it might be in the way you interacted with that person that gets you that next deal or the introduction to the next entrepreneur. So the relationship factor in deal flow is paramount, and it all kind of trickles from there, whether it comes from X, Y, or Z.
So it's really who you know and that networking that's going on at various times. So I think what Matt's saying is, network. Get in front of as many people as you can. Make sure you're known, and it's a relationship thing. I think that's very important, right? Jasper?
So yeah, I mean, we get bombarded in many ways. I've had approaches on Facebook before, which I thought which was great. I've had people on Twitter saying, what about this idea, and text messages and things like that. So I mean, I think there's no, as Matt was saying, there's no sort of tried and tested manner of getting hold of people. Oddly enough, things like LinkedIn have been, I get a lot of inquiries through LinkedIn. People just reading profiles and trying to search for different, type of investors and stuff. Like Matt, I think it's really about capturing somebody's imagination. First of all, is does the product fit? And once there's some sort of glimmer of interest in the buyer, I think it's really just about honing in and being very focused on trying to get the messages across. And really ultimately comes down to the quality of the relationship and trust.
Yeah. Another question in terms of what attributes are you looking for? Are you looking for talent? Are you looking for intellectual property, technology, market share? Is it a combination of all of those? What drives you in your valuation?
I think all the above. In that equation, I think one of the key things from a gaming perspective that we look for is engagement. It's beyond the game. Yeah, you've got a great game, but then how do you take the next step forward there in terms of engagement with the gamers? Whether that's auto-populating contact databases, integration with chat, it's that go-to-market marketing component, that mile between the game and the gamer is key, and that relationship that you build, and that is those tactics, gimmicks, and clever ways of engaging to get longer gameplay. I was just talking with a payments vendor in the hallway, and they were like, in France we can, with one click you could just pay for the game or the in-game component through DSL in France, and it's very seamless, very easy, and that's a huge engagement driver. So that engagement piece is key, because a buyer will look at that to say, nice game, but very, very clever engagement tool. I can now reverse engineer that into my whole game portfolio and really move the needle. So some of those things that go beyond the game is kind of more and more consequence.
That's a good point, Matt. There's just not the game. There's the platform behind the game, the technology behind the game, the transactions. There's a lot of people approach me after each session and said, I don't make games, but I make something that supports the infrastructure of the game or the incentive part. Those are technologies and processes that are very valuable to companies out there worldwide. So, good point.
So our motivation for buying companies generally within PlayJam is to fix problems that we see or to acquire technologies that we think we can't develop quickly enough. And so the three companies that we've acquired have really been for a variety of reasons, but generally to fix hiring problems because we can't find the right quality of staff in an area, to fix a traffic issue, so we think we could enhance traffic in a certain area of our business, and the best way of doing that was to acquire. We've bought one business because we just liked the story and we liked what their vision and what they thought they could do. So I think there are multiple reasons why companies acquire. We were talking earlier about quite a lot of those for larger companies is to do with revenue and fixing quarterly earnings and things like that. But the scale of companies needs to be bigger for that. So from a PlayJam perspective, it's generally trying to fix problems. As an angel investor, I think I approach it from a very different point of view, which is, do I think there's a story that can be shaped to go on and get institutional funding and hopefully an exit. And I think those stories are very, very varied, and they could be down to there's a specific take on a specific piece of technology or a specific game or something like that. But I think it's really the way those things are packaged as to what their value is and stuff.
Okay, yeah, thanks, Jasper. So you're not necessarily too small, or maybe only confined to a certain geographical space, but there may be value there that you may not realize, and it's always good to pursue that with professionals like Matt or Deepak or Jasper or myself to see if there is value there, because we see things worldwide and we see value in a lot of different areas. So don't just assume that you may not be big enough or you may not be in the right space to have value in terms of an investment or an acquisition. Deepak, what sort of red flags have you seen in companies? What red flags scare you away from an investment or an acquisition?
So let me say investments, because like acquisition-wise, I don't think Intel will be active in this space. But let me just say, from an investment point of view, oftentimes I see companies that clearly have some traction in the marketplace, and usually an entrepreneur who thinks that the hockey stick will be here day after tomorrow, and they're trying to raise too much money to achieve that change in the trajectory of the company. That's one. The second thing I'm always concerned about is if after speaking with the company for a while and engaging in a discussion with the company, they don't have a clue as to how they will monetize any growth in this region. And the reason this is important in this particular region, which I cover, as I mentioned again, with Southeast Asia, Australia, New Zealand, is none of these countries actually has the scale for you to grow a company based solely on your domestic market. So you have to find an idea that will scale across regional boundaries and national boundaries, and find a game or a service that people across boundaries will want to buy and use. And so that's a difficult thing to find. And that's a difficult thing to find because, and for those of us who are sort of new to this region, and I'm relatively new, I've been here 4 years. When I first came here 4 years ago, I started constructing a thesis around what would scale across the region. And the two that obviously came up to me based on demographics, income demographics, usage patterns, et cetera, was online gaming and mobile value-added services. And lo and behold, the first thing I discovered is that the top 5 mobile value-added services in Indonesia don't even make the map in Malaysia, and vice versa, the top 5 in Malaysia don't even make the map in Indonesia, which would be a big surprise for most of us because we look at it from a distance and you go, okay, 2 largely, majority Muslim countries must have similar habits, practices, etc., but they don't. And so you have to now scale in Indonesia or scale in Malaysia. The third thing that concerns me often is if the barrier to entry that I see is solely based on language. And a lot of companies, especially in this region, rely on language as the only barrier to entry. Now, here's the problem with language. It's as much of a barrier for you to get out of your country as well. So it cuts both ways. So if you can only scale your business in one language and in one country, and you can't really scale it outside of it, and you successfully kept English language games from coming in, that also means you can't get from Malaysia to Thailand or Thailand to Vietnam or anywhere else. And so that's the other issue that I'm mostly concerned about. I would like to see companies that have the ability to at least demonstrate some notional business model in the home countries and the ability to scale into a new country and build a base.
That is very valuable advice. Very, very valuable advice. I mean, establishing a barrier to entry is a barrier to going and expanding your business as well. I think what Deepak is saying, focusing, having a clear message. How am I going to monetize my business? You need to plan for that. You need to have all of that stuff in place before you go to market and find buyers. And I really think that scalability beyond the region is critical. If you really want to see that success from the beginning, plan for scalability beyond the region that you're in, and you will be in a potential for an acquisition. It was really, really valuable advice. Things that scare you, Jasper, that you've seen, scare you away from deals?
I think quite a lot of young companies, which is obviously where we focus, a lot of those young companies, the story changes the longer you talk to them. And so, you might start off with an entrepreneur who has a really sweet, very nice story, and he sells it to you brilliantly the first time you meet. And then, you meet him 4 or 5 times along the road, and the story bends and twists and things like that. And that's just because, human beings are storytellers, and stories do change, and businesses change, and visions change. But it's quite disconcerting as an investor when you're sort of not quite sure which bit you're going to invest in. I've had 3 investments, and they were relatively small investments, but they were investments nonetheless, where I convinced myself to make the investment in the business because I like the people. And 6 months later, the business was unrecognisable from the thing that we had originally been attracted to. So I think I've learned from that. I've learned from bitter experience, sort of investing in companies where the management team is weak. So there's quite a lot of CEOs and entrepreneurs that are not hugely experienced, that have set up a company and therefore they believe they're the CEO. I have an investment at the moment where the guy is absolutely passionate, loves his business to pieces, works all the hours that God sends, but probably 60% of his work is the wrong work, and he shouldn't be doing it. And so there's a huge amount of time wastage, and that becomes a very emotional thing with the CEO, because the only real conclusion to that is you have to remove him, and that's a really complex thing to happen in a small business that's founder-led. So I think that the things are, look at your management team and believe your management team is the best you can get it for the scale of your business. No one's expecting you to have, the top guys, in a relatively small business, but make sure they're as good as you can get. Make sure they tell the same story, be cohesive about that sort of stuff. And I think the last thing is, don't buckle with valuation. So a lot of a lot of people who begin to negotiate against us are not massively experienced at negotiation, and so it's relatively easy for us to negotiate on price, but they feel quite intimidated about talking up their value. And it's not always the case, but as a buyer, I want the person who's trying to sell me his company to be strong, and I want to know that I can trust that person to negotiate on my behalf, going forward. So.
Yeah, there's a lot of information there. Some very good points, Jasper. In terms of focus, keep the story straight. Keep it consistent. Let's not waver from the focus. If I look at some of the most successful companies out there in the video game industry, trends, they focused no matter what. They said, we are on this path no matter what, and their story never wavered, and they became incredibly successful. Epic, with the Unreal Engine and their games, never wavered from their focus of building the best technology possible. Id Software, first-person shooters, best technology first-person shooters, never wavered. When we showed Wolfenstein to the press in the early days, I'm going way back, every press person told us we were done. First-person shooters would never go anywhere. You're out of business. Still around, doing pretty well. So it's, have some conviction. Make sure that, you stay on the path and you don't waver. I like Jasper's point about valuation. Stick to it. He's looking for that strength and saying, I'm worth $10 million, and I know this is why, and stick to it. I think Jasper's going to respect you all the more for that in terms of an investment, right? Yeah. All right.
As long as it's not too much.
Well, yeah, as long as it's your number.
Yeah, that's right.
That you're looking for. Yeah. All right. You looking for, what size deals are you looking for? Deepak, you're probably looking for bigger deals to invest in as opposed to some of the other deals.
Well, so if you look across the world and look across Intel's investments, you'll see that we're a pretty stage agnostic investor. So we actually have invested in early stage deals all the way through pipe deals in public companies and so on and so forth. And we typically, the more important metric for us is to establish to our investment committee that this is somehow strategic to Intel. And if we cannot argue and articulate why the success of this company somehow benefits the mothership, then Intel Capital, it would be a waste of time for everybody. So we have to always show that somehow making this investment, making this company successful will benefit the company strategy. So with that in mind, I think across the board we would tend to look more for growth stage investments, but this is the one sector where I find constantly when I get the little emails that come out once a week or about the new deals we've done. This is one sector where we have gone earlier stage. And I think that is a recognition of the fact that these things take off very quickly. And if you want to be in a position to capitalize on that growth, you have to take the risk of making these earlier stage investments. Because I think we've missed at least a dozen since I've been in the company where we had a look at the deal, we passed on it, and within a year it had gone to 20 million users or 50 million users or whatever, and then the price we paid or didn't pay in the end was significantly higher, like maybe 20 times higher than what we could have gotten in at. Now, that being said, I will speak for myself in this region. I am very reluctant, as I said earlier, to identify very early stage deals and do $200,000 and $500,000 investments. And there's two reasons for that. One is the mortality rate of such companies in this region is 10 times higher than it is in the US. So that's a great concern to me. And the second is, as I said earlier, I live in Singapore and I cover 12 countries. And the one thing I know about early stage investments is they need a lot of hand-holding. And frankly, it would not make it worth my while and wouldn't actually get my attention to put $200,000 into an investment somewhere and then try to visit that place once a week. And so that's one of the reasons I avoid very early stage deals. So to some extent, I would say my threshold of pain is a minimum of a $2 million investment, which means the company has to have some traction for me to pay $2 million and get some portion of the company.
Good. Matt?
I think there's also a new type of deal phenomenon that's happening. I think Jasper mentioned on it earlier, is that acquiring talent, acquiring intellectual capital. So I meet a lot of companies that think they have a company, but it's more of a product or a feature, and doesn't have a long-term ability to be a company. And the opportunity there, and even compounded, where you have these entrepreneurs that really aren't good and don't want to run a company. Therein lies an opportunity for them to join a broader effort to be part of a bigger social gaming company, a bigger company, etc., and take the administration, de-risk their personal, professional company situation and make them part of something much bigger. So you're seeing this happen with Facebook, with Google. Zynga's doing this, where they're buying 2 to 10 person shops and saying, I'm going to give you a great future here at our company. Here's a big tranche of stock options and a great salary, and come on board and let's kick butt going forward. So that's a new phenomenon in M&A that really hasn't happened. Before, you'd get responses like, oh, you're subscale, you're too small, and call me when you're $1 million or $5 million in revenue, and then we can talk. Today it's like, hey, I love what you're doing. I think you got a great product, a little rough around the edges. Jump in the boat with us and let's do this together. So kind of creating an option for both the entrepreneur and the buyer to really realize that and exercise that opportunity.
Okay. Yeah.
So yeah, I mean, in terms of scale, size of deal, we do anything from $50,000 probably up to a maximum of $850,000, maybe $1 million at a push. But so pretty small deals. We don't do a huge number, just partly because of funds, partly because of time, and partly because we operate our own businesses. So obviously PlayJam being the one we're doing at the moment. What's interesting is how fluid the market is at the moment. So generally, the people who, the entrepreneurs that set up one company are already thinking about, the next one, or a variant on what they're doing. So there's sort of, I think, quite a lot of us are riding a lot of different trains, and that goes slightly against what I was saying earlier about focus and consistency. But particularly in the Bay Area, you've got a ton of entrepreneurs who are sort of 25 years old that have already done 5-6 companies, and then you're beginning to see the same sort of traction in Europe, and I suspect you'll begin to see the same thing over here, where people are trying to incubate ideas and sort of get out the other side. But to Matt's point, I think that whole sort of talent aggregation model. It's a bit like United Artists in the film days.
Yeah.
Studios trying to just corral and own intellectual property, and I think that's going to be a big trend. And if you go back to some of the issues we were talking about the region in terms of getting scale, it's perhaps that model that works best. Is the aggregation of the aggregation of IP, the aggregation of knowledge, and it's just finding the right buyer group. I'm sure there are. I think Gree's done quite a good job at acquiring businesses. There's a lot of activity, obviously, in Korea at the moment. Even the Samsungs and LGs of the world are hoovering up games companies at the moment. So,
Yeah, there is a huge shortage of talent out there, and there's a lot of acquisitions based on talent grabs, getting the best in the business. They need to scale up as quickly as possible. There's also the revenue grab. If you are somebody that has hit the gold mine and I've got a hit product, we need more customers. If I can add 30 million more customers to my database, that's worth X. But that talent grab is going on constantly, and there is a huge shortage of talent. I know, especially in North America and Europe, where the best developers are they're moving to mobile, social, from all sorts of businesses because of that shortage. Good talent there. So if you can get the best in the business, pull them together, there's a good chance you'll be ready for an acquisition. All right. Let's see. Might open up the floor here in a minute. What sort of trends do you guys see in the business? I mean, aside for some of the ones that I mentioned, gambling and other things, social, mobile, were those, what do you see trends in the business that you see in the next 3 years that are going to drive continued high valuations and activity in M&A and investment?
I mean, I'm pretty biased on that one. I guess, you know, we bought PlayJam back and just put, with Adobe and GameStop and various others, $7 million into it to focus it on TV. So, you know, we see these smart TVs as a sort of, you know, a little bit like the dawn of the smartphone industry. It's a bit chaotic today. There's you know, some fragmentation in it. But it's an extraordinary opportunity, we think, because, you know, 76% of the global market's controlled by 4 companies, which gives them a lot of power, but you know, to do stuff. But you know, so you've got a relatively easy access point to a global market, and TV is a pretty interesting device. You know, it goes at its most prolific. It's viewed for 9 hours a day. In the US, it's about 5 hours a day. In Europe, it's about 4.6, except in France, oddly enough, where it's 2. And the French are probably much more intellectual than the rest of us. I don't know, something like that.
Absolutely.
But yeah, so TV for us is a really interesting one. It's been tried a few times before, you know, with pay TV. But smart TV is interesting in that, you know, the silicon, the memory, the remotes are you know, much better now. But the scale of it is extraordinary. So it's about 220 million flat panel TVs shipped annually. They run common operating systems. So, you know, within 3 to 4 years, there should be, you know, close on, you know, 600 to 800 million active smart TV devices out there. So what our view is, you know, can you see an opportunity between, you know, there's about a 97 billion spend on consoles at the moment, 100% of which are played through a TV screen. There's about, I don't know, 45% of all mobile apps or games are played in the TV in the household. So in theory, they'd be better on a big screen than a small screen. And the tablets coming out with sort of HDMI leads and things, there's a lot of connectivity going on there as well. So, you know, it's a hunch, and you know, we think it's worth a bet. You know.
Including Apple.
I know. I mean, I think Apple will struggle in smart TV. I mean, I think that if you look at the Samsung and LG have invested, according to them last week, in the region of 14 billion in building panel manufacturing plants for 3D LED, and they've got zero intention of sharing that IP. So even if Apple, you know, Apple bought some of Sony's assets through Foxconn, they bought, you know, rumored to try and buy, they bought the Retina display stuff out of Sharp, but those technologies are, you know, quite old compared to some of the stuff that Samsung or LG did. So I get, you know, Samsung and LG, I think it's their, you know, they'll fight pretty hard, but it's not to say Apple won't win. But I haven't included them yet, but
Yeah.
we'll see.
That's interesting. I was at I think smart TVs are definitely have
Worth
a good
a
chance.
punt, huh?
Pardon?
Worth a bet.
Yeah. I was at the CES show in Vegas in January, and there was a huge focus on that. There's a huge focus on ultraviolet, which means that you can watch anything anywhere on any device.
Yeah.
Well, what happens if you can play anything anywhere on any device? Well, a big part of that is that smart TV too. You know, how am I doing that? There's that whole standard that people are trying to put together with ultraviolet for just watching, but is there a standard for playing on any device anywhere at any time? And a lot of people have dreams about that, but some way it's going to get cracked. And smart TVs are going to play a very big part in that, or smart devices are going to play a big part of that. Matt, any other trends that you see?
Trends. I'm going to give like a local trend here. I've been in Singapore now for about 7 years, and originally invested in a company here led by a Singaporean tech entrepreneur named Chris Lowe. He had a collaboration product at the time, and we did a pivot and just from cold scratch, started a social gaming company called Viwawa, which is a popular social gaming company here in Singapore in the region. And the local trend I'm talking about is entrepreneurship in Singapore. It is really amazing to me because beyond Chris and some of the other entrepreneurs I've met with in town, it is really refreshing to see, and it's a growing trend. You know, we got the Facebook founder in town, and all these different dynamics happening. The MDA and IDA have done a good job of investing in companies, but from a macro perspective, the capital component in Singapore is still missing, and I think that's I'm seeing certain components that are helping that grow in terms of capital in town that's going to put, you know, $5-10 million in a company and back an entrepreneur. You know, some of these entrepreneurs and opportunities were on Sand Hill Road in Silicon Valley. You know, they'd get funded in a week. And here you've got a little different environment, a little bit more hesitant, a little bit more calculated, but it's also changing. But the entrepreneurship from a theme and a trend happening here is definitely one to watch.
Good. That's encouraging. Deepak, anything to add to that before we go to questions?
Well, from my perspective, I'll just reiterate the things that I think will change in this region and therefore affect this industry. You can see that LTE networks are getting rolled out everywhere. I think that's going to be a big deal. If you watch the Nielsen presentation this morning, you know, only 14% of Indonesians have access to broadband. So, you know, you take the fact that LTE networks will be here over the next 2 to 5 years. You then add on the number of tablets that people will consume. I mean, for all the talk about India, I don't know if you guys know, but India only bought 400,000 tablets last year, but they bought 166 million phones. And you can see that trend, you know, will be more towards tablets and growth over the next 10 years.
Yeah.
And so and then I see the demographics of this region. Only 2 countries in this region actually have a median age above 30, Singapore and Thailand. Everybody else has a median age below that. So most of the time when you get into a train here in Singapore or anywhere else in this region, you have, you know, 20-somethings with handheld devices if they can afford them.
Yeah.
And so I just think that that's in fact what's going to create a huge groundswell of demand, because now you have the device, you have the network, and then as the content develops over time, that's what will grow the market.
That's amazing.
That's
Amazing.
How
And I
many
thought
tablets-
smartphones were just a fad. No, those are amazing figures.
Yeah.
And culturally, what's changing?
Well, the other thing, of course, is, you know, of course, as people get wealthy, they all like cars and all that. But if you look at the traffic in this part of the world, you know, people don't want to drive cars. So that's the other cultural aspect. People are on trains and public transportation. They get time to entertain themselves and do all the things. And if you looked at what happened in Japan and iMode and why it came about and why we were in the U.S., we're not even looking at our cell phones. We just pick them up and answer phone calls. It's because Japanese spend a lot of time on trains.
Yeah.
They entertain themselves. And so that is also happening here. And now they also have the ability to buy these devices. It's making a big difference.
That's, culturally and transportation is having a huge
Yeah.
effect. You know, in the U.S., we just use our tablet while we're driving, we use our phone while we're driving, and we drive into each other and cause accidents. You know, now, it's
You know, in
interesting.
New Jersey, they've just passed a law that
Yeah.
you get charged $500 if you do that.
Yeah, I mean, New York is amazing because of the usage, commuters is huge compared to other places like, you know, Arizona or California, where we're all driving our cars.
Yeah.
All right. Self-driving cars. Yeah. All right, let's open it up to the floor. Any questions for anybody? I'd ask you to step up to the mic and pose your question to our panels. Go ahead. There's somebody coming up right now, but you can go after him.
My question is something relates to exit strategy. Now, I understand you're investors, so sometimes I expect that you would try to exit from those investments. From the 2008 financial crisis, I hear that the VC valuation model has collapsed. You don't have the traditional method anymore. But do you still have the target financial return when you make investment now after the crisis?
I have a very non-institutional answer for this. People ask this all the time. What's your target return? What's this? And my answer facetiously is like 100 times my money. There's no limit to the return I look for. There are other funds that are targeting a 20%, 30% IRR, which is a very comfortable answer and a very institutional answer. But mine's a little different. We look for great entrepreneurs, big markets, and big market opportunities. So it's like the bigger the picture is painted, the more exciting we get, and the more we would want to do. But there's VCs that target different stages, different sizes of investments that have a little different criteria, and a lot of those in town here, a lot of those in Hong Kong, a lot of those in Silicon Valley.
Yeah, I've had many investments where I just wanted to get my money back. So, that would have been great. So yeah, so it's been
Return off money.
yeah, that's right. Yeah. But yeah, I think it's very difficult to have an expected rate of return on cash that's deployed. You can have hopes and dreams and aspirations, but from our perspective, I agree with Matt that you want to be as ambitious and as big and as determined as possible. And broadly speaking, if there's an investor sitting alongside you, most of the time your interests are completely aligned in trying to drive the biggest value, the biggest story, the biggest opportunity. And I think, depending on the investor group that you've got, it's really about refining that, to get the best exit. But yeah, 10 times exit, 10 times return sounds pretty good. I think on most of the investments that we look at. I think as an average, it's probably running at about, across all the deals that we're doing, probably about 6 times or something like that.
Okay. Question?
Hi, I'm Rakesh from Trisensa. We make game development tools and platforms. So following up from the last question, how big of an opportunity do you see, or what are your insights on HTML5 as it relates to game development?
I'll start with that. I think HTML5 is interesting. So obviously, Adobe made a few errors about 6 years ago. And those errors gave Unity an opportunity on one hand to build 3D well, I think. And the bugginess of the original versions of Flash created a requirement for or created motivation, I think, for Google and others to back an HTML5 strategy. I think the issue from a games perspective with HTML5 is that there's no standardized approach, and so if you look at it from a coding perspective at the moment, audio is very, very complex. Oddly enough, in Flash and Air and things like that, audio works very, very well. HTML's got some issues and limitations around animation at the moment, which will be, I'm sure, fixed over time. But I think what is interesting about HTML5 is just that you're getting through Chrome and stuff like that now, you're able to get pretty much straight to the metal, and I think that's a really interesting approach. My bet would be that Adobe will be the tools business of the future. So I think if you look at it in pure investment terms, Adobe have allocated $1 billion to games, to building tool sets for games. So if you look at the nearest competing companies on that, say Unity has a balance sheet with about $15 million on it. So it's a relatively small...
Don't leave out Intel.
Yeah, no. But just in terms of authoring... Yeah, and you guys you've been beavering away. Yeah. So yeah, I think our bet would be, HTML5 will require the same back-end tool sets and tool chains And the same, and some of the companies that are big today will continue to be big, and companies like Adobe will just get rid of Flash as a brand name, but that will take a while.
All right. Thanks. Question? Got a couple more questions before we run out of time.
Quick two-part question. First part is...
What's your name? And
Oh, sorry, Steve Coleman. I live in the Philippines and spend a lot of time in Singapore. And I'm just curious in terms of your investment philosophy. Do you guys individually like to go into investments alone, or do you go in as a group? And if you go in a group, do you like to take the lead, or do you prefer to be subordinate? Sort of the investment philosophy on individual or group. And then secondarily, your philosophy in terms of motivating founders, employees, and existing shareholders. There's the old saying, you name the price, I'll name the terms. And a lot of us, over the years have bumped into situations where, sure, you've got the money, but, the last money and has got 3 times liquidation preferences, and you've got to hit a grand slam home run out of the park to even see. Before you know it, you've got a group of hardworking founders with shares that are, you end up, yeah. So anyways,
got experience in this, Steve?
No, not at all.
Okay.
No, but two-part question. So
Good question on the who else is involved in the deals. That's a very good question.
Yeah, I guess in terms of involvement on deals, we have typically led most of the deals that we've done, meaning we actually have put in the first risk capital. So in some deals we put in the first $1 million, for some deals we put in the first $30 million, and then bring in other venture firms. Intel Capital was a co-investor in one of our companies, and so that's just how we've approached it and kind of gone to market, kind of de-risk the model and put our money where our mouth is. And then in terms of the second question was
That motivation of
motivation.
yeah, founders.
Great question, and it's got to be crystal clear how the founder makes money and how the alignment is there, because there are some. And I see that there's some VCs that really like to over-engineer deals, and when you step into a pile of shit, they're going to make you pay for that and say, this is a 10 times liquidation preference, and you could earn your way back, and then just you could see the founders completely motivation sink, and so you got to have alignment. You got to have a goal there, and. It's like any compensation committee that I'm on, or any equity incentive structure that I'm on. It's like, write your ticket. If it's reasonable, it's going to be a green light. You almost have to have that kind of interaction. And once you get any pushback on that, then it's like, it's a good barometer for the kind of partner you're going to be with, because you should kind of get that out of the way first, and that'll speak volumes of kind of philosophy and kind of approach people have. So it's a great question, actually.
Yeah, I've seen it in many cases. It goes back to when you're being acquired. It's the same with investors or in an acquisition. Do some research on the people that are investing in your company. Look at companies that have invested in the past. Look at companies that have acquired other companies in the past and see what they've done with those companies. There are VCs out there that their primary goal is to take over the company and sell you at the multiple that they expect to sell that at. And it doesn't matter what happens to you, they're going to take over that company. And they'll have all sorts of traps, and investors goes for the same thing. And acquirers, they'll have the same thing. They'll have traps that you could fall into where you lose everything. Just do a due diligence on them as much as they do due diligence on you. All right, I think we're going to have to wrap it up here. Thank you very much, guys. Jasper, Matt, Deepak, great panel. Appreciate it.